What up, guys? My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. So I feel like I haven't seen you guys for a few days. To be perfectly honest, I just had to take a break. First it was my birthday, and my girl took me out, and that was really fun. We went to a concert, and I had a blast. But also all the media and YouTube and just all the fear and all the FUD, it wears you down. And I don't know if it wears you down, but it wears me down. And then having to come onto a YouTube and when everything is so bearish and it's just like, more talk of recession, more talk of real estate crash, more fear and more FUD and, more lower lows. And I mean, in the last video that I did, I explained on Wednesday. It's what the CPI report came out Friday. On Wednesday, I made the alerts. Watch the indexes are coming down. Thursday, I made the video explaining that we're creating a pivot before the CPI came out and what to do and what I was going to do. And I did do that. I took my profits on my longs. I did the inverse hedges. That ended up being a really good strategy. Hopefully, some of you guys took that. But essentially, this is a tough market and it wears you out. And so sometimes you need to regroup. Sometimes you need to go listen to music. Sometimes you just need to go out and have dinner and a drink with friends. Sometimes you need to just walk the dog or go to the beach or whatever you need to do. And I not to sound like a hippie or whatever, but I do these like mantras, these affirmations. And I was doing them every day on the way to work. I had a big manufacturing company, and I had a little commute there, and I would do it every day, talking to myself out loud in the car. And after doing that for a long time, it really resets your mind, and it really kind of just puts you in a positive mental place. And so I thought, okay, well, I need a break from all this fear. So I didn't even want to look at any YouTube videos. I didn't want to turn the TV on. I didn't even want to look at notifications on my phone. I just needed a break from it because you're in the markets all the time, stock and crypto. And then you're on YouTube and you're explaining it. And then you're in the Discord and you're helping people that are, feeling the same way, right? And so, it wears you out. And, you can't really help people unless you're in the right place. So I started having my, falling asleep to my little affirmations and then doing them again in the morning and just, taking a little time for myself to enjoy. And of course, I'm watching the charts. Of course, I'm still waking up in the pre-market, doing everything I do. But, since we pivoted again off that index, like I was showing you in the last video, I went inverse, and I'll just pull it up so we can see while we talk. So right here, I was saying, and you can see in the video, it was just starting to pivot. And I said, look, when this cloud closes, we got to get out. And that was before CPI. Look what happened. And then I kind of explained to you guys, exactly what to do. And that was the inverse ones. And those were crazy green for 3 days. I think it was Thursday, Friday, and Monday, and probably a little bit today. Let's go see. So it's a half and half because actually the day I'm filming this, it's Tuesday, and Tuesday was a great trader's day. There was volatility up and down and good momentum. And so I took I was in the group hanging out. I like hanging out with all the Jedis, and the link to the Discord is in the description if you guys want to come in. We got some new people that came in, some new subscribers, so I've been doing one-on-ones and helping them get set up with their technicals. But yeah, I mean, sometimes you just need a break. This is a pretty savage market. It's not the kind of market where you buy those long conviction plays like your Microsofts and your AMDs and you hold. It's very sure you can do that. You can do anything you want, but it's very hard if you do that. And that's why a lot of the times on this channel I explain the answer to the bear market is pretty simple. In a very, very tight summary, the answer to the bear market is short time frame, trade in and out, pivot to pivot, off momentum with entry and exit rules. It's not about DCA. It's not about long-term hold. You'll go broke if you have 5 positions DCAing for, a year and a half down. It's just I just know better. It's rough. I'm pretty good at doing this, and I've done well, but I'm taking lumps too. I mean, the market's so shifty. I mean, even when you think you're like, oh, the momentum's good and everything looks perfect, and then all of a sudden a hit piece comes out on the news, and boom, it's like bam, a big old purple candle. You can get caught up in that. You get stopped at a loss. You could, it could happen so fast you didn't even you were typing in the stop and it happened. So, I mean, it's chaotic, especially like this zone right here where the pivots were really low. Like these big ones are nice, because they're really, you can run them, okay? And like this. But this little coiling, this was crazy. This was a crazy time. So when I made that video last, which was a very informative video, and I put everything in about the Fed playbook and the order that everything goes in just one concise video from real estate to how they do the federal fund rate and how they pull you out of recession with the playbook, like every little step. And if you watch that, you'll see that every one of those things are happening, except that they're not telling you that that's what their playbook is. But it is the Fed playbook, and they pull it out, they blow off the dust, and they pull it out, and they do the same thing. And they did it after World War II. They did it, back in the early 70s, and after Vietnam when there was high inflation and different time periods. So in the 80s as well. So it's the same playbook, and it's very unfortunate because when you have been in the markets and you understand the markets and the different historical time periods of the markets, you know what's coming. And even though I've been walking you through the whole bear market and kind of was helping you guys get out and then showing you how to trade in and out off the pivots and showing you good technicals and ways to enter and exit, still, when you know the Fed playbook and you kind of understand where you're at in the whole process of it, it can wear you out and stress you out, because it's not like, a straight up bull market where you can just throw your money at something and it goes up and up and up. And it's an overnight and you can hold it for 2, 3, 4 months or, this kind of thing. This is like day trading and pivot to pivot, short time frames, looking for momentum, working with things that stack probabilities like indexes moving, sectors moving, industry groups moving, the right day where it becomes risk on. But remember, risk on, there's no reason for risk on. Even Tuesday, when there was good volatility for trading and you had some big momentum rallies, and I'm sure a lot of money was made on those rallies up and down. I'm looking at them over here. The indexes are beautiful for that kind of trading activity. Even that is, if you go back to my older videos where I explain how large firms, institutions, prop firms, what they do is when they're down on a position and they want out before CPI or before FOMC meetings or whatever kind of catalyst might be coming, say like the day that you're watching this when Jerome Powell is going to speak, they will 5x down and they'll have the same dollar loss but a lower percentage, but they'll do it into momentum to springboard out, and then that's how they can de-risk and take down leverage, or take leverage off or margin off, if you will. So it's tricky. You see those and you're like, ooh, NEO up 17, 18%. And I did take that one. It was probably not the best example, but yeah, I think it went up. Yes, almost 17%. I mean, a beautiful one, right? So you see that and you want to get in, but even though I got in, I've been burned too many times holding overnight, especially on a major catalyst day. And I noticed that right before these big FOMC meetings, there's usually a big rally and then a rug pull. And so, it sucks because, I rode NEO twice really well, and I did it off the hourly. I'll just show you kind of what I did. So we ran this. These are hours. So this is a few days, this is a week ago. So we ran this. We got in, got out. Okay, I think we got in here, got out, and then I protected all my money and just got back in. And normally, because this is the hourly, I would stay in. But because of the catalyst and just the pattern recognition over the last, 8 months of this stuff, I just had to exit and just take my profits. And it's okay to day trade and grab $300, $1,100, $800, whatever, and just pull it to the side and have the cash, instead of trying to hold through this market, because it is quite crazy. And that's why I like being on the hour or less. But when it's like super volatile, I mean, like on the minute time frame, scalping is just off the hook right now. I mean, look at crypto. We'll talk about crypto, obviously, but I mean, crypto. Actually, you know what? We do need to talk about crypto while we're chatting here. So 21,500 is a level I had mentioned a while back in a video. It's unfortunate that this broke down like this. The Celsius thing is a big deal. Anytime in exchange, there's a fear over you not being able to get your money. I look at that as really bad. But if you go way back to this line, this has been on here for a long time. I had this pivot low over here. Okay, you're at like the 21.5, and if you go to the hourly, I would just put a little thing in the Discord about this. I wrote, guys, this might be a double bottom, and if it double bottoms off this line, and notice how this is actually blue. If it double bottoms off this line and starts getting momentum, well, that would be a really good entry point because you're establishing the floor off this level, the next level, which is about the 21.5. And if you look more closely, you are boom, you're bouncing and it's starting to bounce. It's not like insane volume or anything, but this is how it starts. Like the momentum breeds momentum. It'll amplify with volume and expand. And technicals should be, number one for traders. But right now, like consumer sentiment is so bad and the catalysts are just coming in left and right from the media FUD that, dude, we're all just getting like mollywopped. We're all, even if you got your capital protection and you got your entries and exits, you're gonna get hit somewhere. You got to be extra vigilant with those exit rules. You got to be really fast. Don't have too many trades open. Like you just got to be really protective in this bear market of how you do things. And I feel like I have a really good sense of all of that stuff, but it still wears you down. When I enjoy going on YouTube and watching YouTube videos. I enjoy putting in my ear pods and chilling to that kind of stuff. And you can't even look because every title and they're right. Their videos are right. I'm not saying they're not. But it's a lot, psychologically. And sometimes you just have to regroup and got to think back to like, things that you like to do. And that's not just all like technicals and trading. Is there other stuff that you like to do? Maybe you like to work out. Maybe you like to, go play poker. Like whatever, like pick up the phone and get a game going or just do something else so that it's not only this, because if it's only this, it can really wear you down. I had a one-on-one with a guy earlier and he was telling me like, with the time that he has, he basically comes in and out like twice a week. And I thought that was a great idea because you can get a lot of anxiety by being in the pre-market, the market, the aftermarket, and then trying to run crypto too. It's, it can take a toll. So I thought, that's a good idea. You're finding a happy medium. You're finding a balance. That's why the color gray is so beautiful. It's balance. It's the middle, right? It's not black or white. It's in the middle. You're finding balance. So, I had to find some balance. I had to go to a concert. I had to go have some drinks. I had to go relax. I, just kind of like decompress a little bit. And, but I don't want to leave you hanging too long, So, it looks like we're getting that balance. Now this is on the minute. So on the hourly, you don't see the cloud yet, but we can see it coming in because we know the support's here and we know the money is shifting. Okay. That means that people are buying more than they're selling and a lot of other things are going on and it's just showing up in this blue line. And you could tell that's, if I enlarge it right there, see how it's a little doji? That's good. So we'll have to see. Bitcoin might be coming down for this little bounce, and all these candles are just going to make one candle over here, and hopefully this will actually go blue, and so will the volume on the hourly. We'll just have to see how that goes. But like I said, we're definitely not in a fundamentally driven market. I'll be doing all kinds of videos on fundamentals when we get there. We're just so detached from fundamentals right now, it's pointless to waste your time. Oh, look, it just went blue. See? The purple doji just went to a blue doji. Why? Because all the minutes are adding up in the hour and the momentum is coming in. Okay, price action above the 200. This is looking good. Ribbon's blue. You're getting all my conditions. There's that volume. It changed colors from purple to blue. Boom, blue momentum. And now your doji on the hourly. Now, if we can get it to have a doji and the next hour, which is in 36 minutes, comes out, and then we start building a cloud, this will be a double bottom, and this will be an epic spot to enter. Always have your stops. Always have your exit rules. You know, don't mess with leverage if you don't really know it. It looks like that candle is growing even on the hourly. Woo, what's going on? Oh, uh-oh. Yeah, see, we're getting a little love right here. This is cool. Now, remember, Bitcoin's like an index, okay? It's like the Dow of crypto. So all your cryptos will go up. But you got to remember, like, if you just look at a lot of the stocks have come down 90%, but yeah, Bitcoin has come down, it's like 60, right? 60, hold on, let me fix it for us. 68.48. So actually, Bitcoin's held up better. But if you go look at the cryptos, the alts, they're down a lot. And you really got to pay attention to this Bitcoin dominance. There is something that just, I'm doing this on the fly. I just speak what's on my mind, okay? I don't have it all planned out or written out, okay? I'm just going loose style like right now. So look, check this out. Something that I noticed yesterday and I was talking about in the Discord is, and this is something we all need to really pay attention to. You notice how, like, when you get these big purple spikes right here and it comes down, you're not far from a rally, okay? Big purple spike down, rally, okay? Big purple spike down, it wasn't very long, there was a rally, and the volume ended up shifting, which is a different way to look at it. Again, right here, big purple, then a rally, okay? All right, so we got one here, and it kind of held, though. It held right on that line, which I thought was pretty incredible that the bulls and bears really tried to hold this line. I still will remember that for a long, long time because this was so significant over here, way back in July 20th and June 22nd, this big double bottom. And for us to hold with like 15 touches over like a month period, that's a fight of bulls and bears. Now, Celsius happened, catalysts are happening, it hits a fan, but that next spot is essentially right here. And what I wanted to say is you need this big purple wick to happen before we can get the next run, okay? So you need the big purple one to happen before you can get the big run. You need a purple, like a big, they call them capitulation wicks, okay? Now, I'll tell you a little hint. It's really good that we see it on the daily. However, you really want you want that to be on the weekly, because when you get that on the weekly, it really is showing that within that next short time frame from that capitulation weekly wick is going to be a rally. Okay, I'm not saying a bull run, but a rally. So look. Big one, it wasn't very long before you had it. So we just had another one, and this week isn't over, but you can see how the volume is definitely like coming up. So we'll see if this week ends up, today's Tuesday, and it already has this much volume. So for it just being, because Sunday's the end, so it's only been 2 days. So that's a lot of volume for the week already for only 2 days in and 5 days left to go. When you look at these, and these are 7 days and they're way lower. So we might get one of these big ones, and then we might actually get to jump up. We'll have to see, but it has played out other times, quite a few times actually too. And this goes back for many, many years. So anyways, we'll just have to see where Bitcoin goes. It's unfortunate that it failed and dropped down here. Everything is pretty bummed out right now in all markets. And that's the thing. I was trying to explain this to one of the guys in the Discord. He was worried that Bitcoin, is just all over. And another guy said, is crypto before its time? And no, I don't think it's before its time. I think that it's a 30-year window. And we only have the first third of the 30 years. It's kind of like the EV revolution, okay, for electrification. Our EV vehicles are still in the infancy stages, okay? It's going to be going, up overall in that industry group till 2050 or further. So no, crypto is it's not done with. It's not over. If you just zoom out, when in doubt, zoom out. And these we're just in phases, okay? And all markets come down together, okay? So real estate will come down, stocks will come down, crypto will come down. And maybe it wasn't that way for crypto in the past so much, but crypto is relatively new, you have to remember. And Wall Street has their fingers inside of crypto. And that's why I always talk to people in the Discord about the high frequency trading and the algorithmic. I'm like, oh, look at this shit stock in healthcare is going second to second on the candles with Bitcoin. Why is that? Because Wall Street they're tying it. Why did every single thing go the same as the NASDAQ? And then right before Terra Luna, I told everybody they disconnected the algorithms, and then crypto fell and the NASDAQ went up, and it made a divergence. And I was explaining that in the group, that I had seen that, See, that's what happens when you just stare at freaking charts on the minute time frames and less. You just notice all this weird stuff. But yeah, I mean, look, this whole situation is a process, okay? A bear market, these things take time, and it's unfortunate because we want them to go up. Obviously, the last time there was a big bear market was the V-shaped recovery in the pandemic, but you had the Fed to come in and stimulate the economy, which created this major uptrend, this big, magnificent bull run. And, they got to pull the liquidity out. They're going to want to pull it out to at least here. And honestly, the stock market is so fearful that it's kind of doing the Fed's job for them, which is interesting. But we got a lot of problems. The main thing is, I'll just walk you through. I'm going to try to be quick because I know I can get long-winded. The main thing that the Fed made a decision on, Jerome Powell and Biden in a private room at some point, they made a decision. Yellen, I'm sure, was there, a couple economic strategists, and we weren't privy to it, and I wasn't there either, but I'm just assuming this is how it went down. They came in and they said, look, inflation's going to be a problem, and we're going to have to we're going to run the risk of losing value on the dollar and the world reserve currency. And this conversation probably took place before the war between Russia and Ukraine. So we're still really dealing with like pandemic and kind of reopening and stuff. And I'm sure there was a big conversation, and they're like, look, inflation's going to be a big problem. We're going to need to really get our arms around it. And maybe one of them was like, well, what do you think we should do? And he was like, well, Jerome Powell maybe told Biden, well, we got a couple options, man. This is like the deal. Like if we let it run hot and we keep these rates down at zero, we run the risk of not being able to get that genie back in that bottle for a long time. And maybe he asked how long. And maybe Jerome Powell was like, I don't know, 6-10 years long. So maybe then Biden's like, well, what's the other option? He's like, well, the other option is we raise rates, we crash the stock market, we put us in a recession, we protect the world reserve currency, we pull liquidity out of the market, okay, we deflate people's portfolios in stocks and crypto, take the liquidity out so either they panic sell and don't have the money to spend so they can't do consumer spending, or they're in a long holding pattern and can't touch the money, which also helps that. And then, let's go ahead and if we do that, we can get the genie back in the bottle at some point. But it's going to take more than that. We're going to need to not just slow the consumer spending, but we're going to need to freeze hiring, which will naturally create layoffs because we're going to control the narrative on demand. And these companies aren't going to need so many people because they're not going to have so much demand for their products. So we're going to have a deceleration on earnings, which will also pull liquidity out of the stock market. But we're going to need to even go harder than just layoffs and freezing and controlling demand and pulling liquidity out of the market. We're going to need to pull down that real estate market too. We have to pull down, we got to basically everything we propped up, we got to kind of take out to get back to a normalized rate, which is increasing from the target rate. But that's a different video, whatever. It's just part of the political, that's a political playbook. And when you're in trouble with the Fed, I suppose, you do little things like that by saying, yeah, our target rate's 2%, and then now it's 2.5, and soon it'll be 3. And we don't know what the normal rate really is. Like I don't know what it is. I'm not sure if it's out there. I think it's around 2.5 or 2.75, but I'm not clear on that myself. So I'm not sure, but I am sure of what the Fed is doing, and they're purposely putting us into a recession. And everything that is happening on purpose. I am sure of that. And when it comes to soft landing, let me just explain in real like simple terms. And the only reason I'm saying it that way is because I actually wrote it out for the guys in the Discord, and not even thinking about it. I just was responding to something and wrote it out. And when I read it, I was like, oh, that's a good way to explain it. So soft landing basically means quarter point basis hike. Okay. You're doing gradual rate hikes, so it shouldn't be too hectic in markets, and we should be able to deal with it because it's kind of gradual and soft. Something a little bit more aggressive, soft-ish would be 0.5, okay, 0.5% rate hikes. Something that's like kind of like a hard landing would be something like a 0.75, okay, and something that's like a crash landing, but you still live, is like 100 basis points, like a full percent. And then a straight up getting hit by the firing squad is anything over that, like the Volcker style, okay? So soft-ish, aggressive, crash and burn and die, like that all has to do with the frequency and the amount of the rate hike. So when you went from soft to softish, all that means in like normal terms for you and I is quarter point to a half point. Now they gave guidance, okay? So everybody's so worried about a 0.75 basis hike. Jerome Powell said he wasn't going to do it, and but the media just loves to spin up the fire, right? But then Goldman Sachs yesterday, Monday night after the market closed, I think Bank of America too, came out and said that and then the Wall Street Journal was involved, and then CNBC reported on it. So I was watching all this last night, and I was going to make a video. There's a lot to talk about. I'm just talking about it now. But I saw all this stuff going on, and they were writing stuff like, get ready for Tuesday. It's going to be a really bad day. Well, we just had a really bad day on Monday. And they were saying that because Goldman and Wall Street Journal, and now CNBC, and I think Bank of America came out too. A lot of people are betting on a 0.75 basis hike. But here's the thing. It's a really sticky situation. I can't see any possible way that it's going to be good either way. A 0.5 is not hawkish enough to get inflation down after we just saw the inflation go up on last Friday. And a 0.75 is going to rattle markets, going to be rip the Band-Aid off. But let me tell you the real story. The real story is that 0.75 is just not enough. If you're at 8.6 is what they're claiming, then, essentially, if you wanted to be at a target rate, you would have to raise the rates to 6.6, okay? So if it's at 8.6, you got to raise it to 6.6 and leave inflation at 2, if that's your target rate. You can't do that all in one shot, though, because if you do, that is a super hard landing, okay, if you will. And what ends up happening with that is you slow the economy to like a crashing halt, and it's like a deep, hard, severe recession. So everything to do with their decisions, softish, aggressive, crash and burn, like all these things have to do with the Fed and the federal fund rate, because as they raise rates, it slows down mortgage applications, mortgage originations, demand, and the housing market. It just all these things start to happen. The layoffs, the bankruptcies, the foreclosure, all these things. So if they come in too aggressive, that all gets sped up. It's coming regardless, guys. It's all coming. You just gotta know that. If you don't know that, just know that. Like I'm telling you that I've been telling you that for 7 months, 8 months. Like that's what's gonna happen. It's unfortunate, but we're not through the woods, and it's great to catch these rallies. There were some great intraday trades on today's Tuesday. And look for volatility. Maybe it'll be to the short side on Wednesday. Just know that I can't personally see anything that has changed. I can't see anything that is like saying it's going to get better. The only thing that's going to make it better, honestly, is time and this is going to be a long process. I personally, I don't want to be like a super bear or anything. I'm just kind of a realist. I've read a lot of books. I'm in the financial markets. It's kind of my deal. I honestly think that, this is probably recession sooner than they're claiming, and it's gonna last longer than people think, and that's just my opinion. Like, I know some people think that real estate, it's gonna be bottoming at the end of 2022 and or into 2023. No, bro. Like, I don't know how old you are. I'm older, dude. I've been through this. That's not how it works. It's when it inflects and we're in inflation and the rates go up and you start seeing all those things, dude. You're looking at like at least a minimum 18 months of coming down, probably 2 years, most likely 2.5 on just the down. Okay, then you're going to get that like kind of inflection, and the Dow will show, and maybe there will be a little easing, and they're going to do what do they do in times like that? They give businesses like incentives, just like they give electric vehicle subsidies. They give subsidies and incentives for companies to hire, and they'll do that through the counties. They'll do that through the colleges. They'll set up programs and they'll re-stimulate the job market, okay? And then they'll do a little bit of easing. They'll come down a quarter point on the rates to start stimulating lending, and because by the time you get to that point, you've got foreclosures, you got bankruptcies, you got layoffs, you got unemployment, you got a shit show on your hands. And again, I apologize. I'm sorry. I know it's hella bearish. It's hard on the psychology because I feel it too. It sucks because I know about this, and I just it's just what's going to happen. And that's why I keep saying in all these videos, I'm like, dude, I don't. What am I the idiot? Like, I've been right about all of it, but like they're saying these huge economists and global strategists are saying, we're at peak inflation, or we're they're not going to do that. Like, what was it? All the economists. There was all these economists that came out and said that we would be coming down a certain amount, and we actually went up. Like, they were all wrong. And I didn't know if we go up or down. I thought we would tick down like 0.2 of a point. So I was definitely surprised, and that sucked too. But I mean, man, it's crazy how so many of these people don't think we're going into a recession. Like, dude, we're already in it. Like, what the hell? Like, and then when I see the accumulation in the volume and I hear them saying these things that are contrarian to what they're saying, but what they're actually doing, I'm like, God damn, these guys they love to manipulate the retail. Yet there's only 13-14% of us left in the market. So why are they trying to manipulate such a small percentage? Are they trying to go after each other? Like, dude, I can see accumulation in volume across sectors. People are nibbling. People are there's buys going on. I'm watching percentages go up on institutional support, and I'm watching like fund holdings, and there's some accumulation going on down here. But yet they're all just coming to terms that we're going into a recession. No, man, the Fed playbook. We're already in it. So where are we at in the Fed playbook? First, they decide to crash the stock and crypto market. You guys already know we're in that. That one's cool. 2 is basically consumer demand. They need to slow demand, and they do that by crashing the stock and crypto market. That's already showing up on the earnings reports. We're already there. The next is they come out and you start seeing the freezing of hirings and the layoffs. That's now just started. Okay, there are 4 more parts, I believe, to it. So you're about halfway through, and you have to understand a couple things when I say halfway through. They're not all tethered together. Okay, they're all in, how do I say this? They're all in sequence in the order they go in, but they don't all happen at the same time. Like, for instance, the stock market doesn't start crashing at the same time the real estate market happens. Historically, it's 6 to 8 months after the real estate market comes down. We're at month 7, okay? From here to today is 7 months. We're 6 to 8 months historically, real estate comes down. We're right smack in the middle of it, and all the reports are showing it, okay? So it's in sequence, but doesn't all happen. Just like the layoffs and the foreclosures and bankruptcies, they don't all happen on day one. It's a staggered effect. And that staggered effect, like, imagine like a slinky, okay? It starts with the stocks, and then it's like the consumer demand, and then it's like the the freezing, the layoffs, and then it's like the real estate, and then it's like the foreclosures, or it might be the credit market, then the foreclosures, and then the bankruptcies, and then stimulate subsidies, incentives, quantitative easing, and then there's this bottoming process. Yeah, just like this right here. This is oops, sorry guys, sorry. 1 second. Let me explain something. Okay, when you look at this chart, you're probably like, this is the top, and we don't know where the bottom is. But the way that it actually works, and yes, you can look at it, that's a true, accurate perspective. I'm not saying it's not. But actually, this whole area, I don't know how you do that. Oops. This whole area right here, this is a topping process. And this, basically, let's start it from here, because I think that's more accurate, was August 12th. Okay, and this right here, for its first lower high, would be January 13th. August to September, October, November, December, January. That was a 5-month process. What have I said in all my videos? The topping process is typically about 6 months, and the bottoming process is typically about 6 months. And then there's a time that goes up in the bull, and there's a time that goes down in the bear, and I've depicted all that very accurately against historicals, okay? Now, when we get to that quantitative easing zone, I'll figure that out later. That's a bottoming process. So it has to do all this stuff, and it's gonna keep coming down. You think just if inflation comes down that the market's gonna just all of a sudden rally? No, because of the slinky, the staggering effect. There's now layoffs. There's like depressed psychology. There's real estate. People's wealth is their, not just their 401k, but now their real estate. So it's staggering. So that takes time. And when I say time, that's typically the time. What was it in 2007, 2008? Just let's take 2008. Okay. Well, it didn't really. Well, I don't want to say this wrong, so let me just go look. I think it was 4.5 years, but I want to be sure about it. I don't want to just say it and be wrong. Okay, so here we go. This is the financial crisis. And even though the stock market came down, and the real estate market came down a lot faster in this particular time because it was all about mortgage-backed securities and credit default swaps with adjustable home loans and stuff. But basically from here to the peak, all the way across, which is pretty far. So from here, just to get to even, I'm just going to show you real quick, and then I'll show you something else. Here. And it says it was October 10th, 07 to March 4th, 2013. So let's just round up to 8. Say 8, 9, 10, 11, 12, 13. 5 years. Okay, that's just to get back to even, okay, on your homes and your stocks, if you will. Okay, obviously, there's, you don't have to wait all the way to here. That's just when the new, more money appreciates on your stocks and you're past even, you're going up. Obviously, we want to be buying down here, which took less time, but still years, okay? So, we want to come in here, and this is when jobs will be coming back and subsidies and incentives and the talks. It'll probably be talks, not even quantitative easing. It'll be talks. Just like in 2021, they started talking about it all summer, but they didn't actually do anything and ended up so far behind the curve. They didn't do anything until March 2022. I mean, it was like 9 months of talk and 9 months of no action. And now we're getting action. And we were having fear, uncertainty, doubt, and a sell-off in the stock market just because of talks. So when they start talking about quantitative easing and they start talking about getting the labor market back together, well, this starts to happen. And they might not even have actually lowered until way over here and maybe another over here. And then maybe they were like, oh, we need to slow down and this happened. And then they're like, okay, we'll add another, we'll take another quarter. And, that's what makes markets happen. The Fed crashes markets, the Fed makes markets. They make them and they break them. That's what they do. That's what they do. And you better believe that the Fed knows what they're doing with the playbook. There could be a lot of different adjustments made to do it better. That's just my opinion. But they know what they're doing, and they're doing all this is happening on purpose. And they had a little backroom meeting, and they're like, lose the world reserve currency and never get inflation and end up like Venezuela, or protect the world reserve currency, crash the stock market, screw them for now. It's a small, we're going to lower rates later. At least now we'll have rates higher so we can actually lower them later, because we can't really lower them from zero. We can't pay people to borrow interest. That's negative interest. So they know what they're doing, and this is a process, and it takes its toll. So, take a little time, pick your spots right, and, if you need a break, it's okay. Take a break, go to Vegas, go out with your buddies, go have some fun. Like, if you're a girl, go do your hair, just whatever. Just, you don't have to do it every day. And in a bear market, it's extra tough, and it wears on you. But, I personally don't see anything that is really going to make this market happy right now. So even if inflation came down, I don't think it's going to completely make the market happy, because by the time that actually does happen, there's going to be other FUD, like real estate's coming down or layoffs, okay? I don't think that raising the rates 0.5 basis hikes is going to make the market happy. It's still going to make them fussy, because they know that a 0.5 soft landing or softish landing is not enough now to get it down. But I don't know why markets forget this one thing that they should never forget. It takes at least 6 months from the time the Fed actually starts raising the rates for it to start showing up in CPI. We've only had, March, April, May, and now we're going to be in June. So it's not going to be like coming down for at least 6 months. So we've only done 3. We got 3 more to go, June, July, August, right? So then it'll probably be like starting to take down, but by then, we're going to have these other economic problems. And if they go higher, 0.75 or even 100 basis points, that's going to piss the markets off too. So I just don't see anything really that like makes it like a risk-on environment. It's simply a pivot to pivot, momentum-based, in and out, rules-based, conditions-based, if you're going to be in. Or just don't be in. But essentially that's the deal. And the trick with this is momentum, pivot to pivot, tight rules on your entries and exits, and short time frames. I'm telling you, that is the answer. That is how it's being done on the big scale. That's how it's being done. That's how I'm doing it. Everybody else is trying to buy whole dollar cost. They're getting like trashed, just destroyed. I can't even imagine, just destroyed. You can't do it that way. That's why I just say the same thing over and over on every video. That's another thing about these YouTube videos. I don't want to always say the same thing over, but I don't know what else to say. Like, it's kind of like, I already know where we're going. I already know what's happening. Like, I've been trying to walk us through, and I guess that's why I'm trying to walk you through like the deeper stages of this now that we're like, part of the way through. So the stock market is going to, come down first. Labor will change, real estate will change, and by the time you get like that unemployment starting to come down, usually the Dow will come up and the stocks will start to come up, and then the incentive subsidies and real estate and lower rates, and it'll start back up. It'll take a long time to get back to even from this peak, but it will essentially, it'll start, and it usually is going to take 6 months of a topping process. Can be about 2.5 years down, 1.7 to 2.5 down, and realistically, that bottoming process is about 6 months, and then it goes up. Now, if they just come in hardcore, like a V shape, like quantitative easing, like complete, like it's not soft landing. It's like moonshot or something, heaven shot. I don't know what it would be called, but Yeah, if they just started like easing, quantitative easing, like hardcore, yeah, it'll shoot up. But they're not going to do that because they're everything is extreme. It's gone way up and needs to come way down. It's going to find its stuff in the middle, the reversion, which is the 200. Okay, and for real estate, it's actually the 10-year average of the last 10 years for the price. And it's going to, like, it's swung way up now. It's going to go to the average. It's going to come down further, and it's going to come back up. Everything is so extreme. It's not just going to come down all soft to the 10-year average. It's going to go below it, and then it's going to make its way back up to it, and eventually way up above it. It always crosses the line. Just like here's the line, and it was way above it. Now it's way below it. Eventually, it's going to go way above it again. Okay, but it just takes time, and you just have to like think about what it is that you're trying to accomplish. Me, I like being on those short time frames, momentum scalping, just grab and go, snatch and grab, straight burglary style. Boom, Neo, it's momentum. The industry group's moving. Chinese stocks always move the day before FOMC because Chinese data comes out. Commodities always move, so I know that. So I'm like, boom, boom. I'm gonna grab Baidu. I'm gonna grab Neo. I'm gonna run that momentum before the catalyst, and it's like clockwork. So yeah, let's just leave it there. Hopefully, this kind of just paints a little picture. Just put the armor on. Make sure you got your capital protection, your entries, your exits. A system will help you with anxiety as well because you'll be more robotic and less emotional. And please come on into the Discord and come and meet me and everybody else. And if you want to subscribe, just once you come in the Discord, which is in the link is in the description, just go to subscriptions and you can subscribe. And you have full access courses, one-on-one coaching, alerts, everything. And that's $99 a month. So it's not bad. It's very worth it. And everybody's cool in there. So I'm going to leave it there. My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse.